Multiple times I have said ICT students overcomplicate things, and the truth is that they do. You seriously only need one candle. Many students have found success with this, but today I am teaching you the anatomy of a candle and how we can use that single candle to find what the very next one will do every single time. Today's video will be a deep dive into this concept, and you will never need another ICT bias video again. As usual, we are not going to waste any time. Let's get started here because this video is important. This is the single most important video I've done yet. So this is a deep dive into the anatomy of a candle. What do I mean by anatomy of a candle? First of all, we have to define this. So what exactly do I mean? The anatomy of a candle is simply an open, a high, a low, and a close. Now, that sounds simple. But each one of these four things we can use partnered with the previous candle to figure out what the next one will do. What do I mean by this? Well, in simple, okay, look what we've done here. If we cut out all of these candles and leave these two here, if we just focus our attention on these two, we can work out a lot just from this, okay? So the anatomy of a candle, what I have come up with here is the idea that each piece of this candle has some information behind it, and we have to use that to determine what the next candle will do. Okay, so this high, what rests above all highs? As we all know, as ICT traders, we all know liquidity rests above highs. Okay, so liquidity rests above here. Once this is traded above, what rests below here? Now it's a really small wick, but what rests below wicks? Sell side liquidity, right? So if we have a directional bias and we've taken out the candle high, okay, and we can now look at the candle low, we have a range here, okay? We have a high, an open down here, a low, and a close, okay? So we have the full anatomy of a candle. If we've taken out buy side liquidity, we aim for sell side liquidity. Now, once we dive into this range here, you can see that this candle here, that wick is the high. This is the low of the candle, okay? Look what happens. We trade above the high, taking out buy side liquidity. Now we wait for a shift in market structure. We shift lower, we sweep up some more buy side liquidity into the previous candle's high once again, and then at a key time, we distribute. Now, where do we distribute to? If you head over back onto the daily chart, this candle's low, okay? So we've got a bias on the 15-minute all from this one candle because we've taken a high and we've taken a low into a key PD array, okay? So let me show you once again what I mean here, okay? Look what we do here. Now, the key thing is we need a directional bias. Now, you might have heard of CRT. CRT is candle range theory, and I don't hate CRT, okay? There's a lot of truth to CRT, but what I think people miss is the context. Why does CRT work? I don't subscribe to CRT, but a lot of the concepts used in that are the whole truth, okay? But a lot of people miss why the whole truth. And it's ICT's concepts. These will always be ICT concepts, okay? Look at what we have here. This bit of price action. We have a fair value gap that once traded through becomes resistance, okay? We have a fair value gap which gets traded through and now is used as resistance on the other side. So once we trade up into the top of this fair value gap, we have context. Okay, we want the market to go lower because we're trying to clear out this liquidity and we have a discount fair value gap to aim for. Once we trade back up into here, we have a bias. But also, if I move this out the way, look at what we're doing. The anatomy of a candle. We've taken out the high. Now we have a low left. The key here is we've taken out a high into a key level. Okay. Once we take out the high into the key level, drop down, and now we have a market maker sell model. we run the previous day high, which is here. And now, because we've ran buy-side liquidity, a previous day high, we wait for a shift in market structure, and look what happens. A low gets broken with displacement, and it forms what? A fair value gap. Really simple. The 2022 model presents itself, okay? All we're looking for is a prior day high to get run. With context. That's the key thing everyone misses, the context behind it. Once we trade into a key level, this idea works. This anatomy of a candle works, okay? Let's look on the weekly chart, okay? Now, with my private mentorship, which is the top link in my description, if you check that out, all the details are over there. I called this high, okay? Now, how did I call this high? It's the exact same thing. We were in an extended premium, okay? So we were in a premium naturally because we're at all-time highs. And then we traded above a swing high. So we're in a premium inside of a premium. Okay, rewind that. We're in a premium because we've traded above a swing high, but we're also inside of a larger premium because we're at all-time highs. That's a gem right there. What does this candle do? Okay, look at the key thing here. The key thing here is, I'm going to dive into the anatomy of a candle even further now. Okay, so listen up. As you all know, we take out buy-side liquidity, okay? But where does the candle close? Remember, this is a video on the anatomy of a candle. We're using the whole candle. I'm not just teaching you the high and the low, because that would be CRT, and that would be missing context. This candle's body, where does it close, okay? So we have an open to the close. The candle's body closes inside this candle's body. Okay, and bodies are where the volume lies. Bodies are where the volume lies, okay? So the volume of the market lies in the bodies. So we want this candle's body ideally to close inside the previous candle's body, okay? Creating that swing high. So the next candle should deliver an open, a high, a low, and a close. And using the candle anatomy I've taught you here, we want it to close in the top half of this, ideally, okay? Because that would set up a market maker sell model. If I extend this out in time, if we take the body of this previous candle and we take the top half, this is the top half. Why do we need it to close inside the top half? Simply because that is a premium. So what we have done here, let's recap really quick what we've done here. We've taken out a previous day high. So we've taken out buy-side liquidity, okay? We've then closed inside a premium of what? A premium of this candle's body. That's the key here. Take the candle's body range. Why the body? Because that's the volume. There's a lot of orders and the algorithm realizes that. The algorithm is programmed to realize that. Once we close inside the top half of this candle, okay? Now we can see, we can drop down onto a lower time frame and there will be a market maker sell model setting up, okay? Look at this big drop down. This is the candle's body. Remember, it closes, that week closes here on Friday, okay? The weekly candle, closes inside the premium of this body. So it sets up a market maker sell model. The next week opens up, okay? So let's take our weekly open. Now, if you're familiar with my videos, you might realize we're combining a few concepts here. I've taught this before about the weekly open. What we want to see is a Judas swing above the weekly open if we're bearish. What do we get here? We take out some buy-side liquidity above the weekly opening price and we start to shift lower. And what are we aiming for? If we head back up to the weekly time frame, okay? Let's head back up to the weekly time frame. Because this candle took out buy-side liquidity, closed in a premium of this previous candle's body, now we can aim for the sell-side liquidity that rests below that first candle. It really is that simple. This is a whole model in itself, and this is why I said in the intro, it is the only ICT video you will need. because it incorporates so much, okay? The best market maker models are found using this, okay? We're in a premium inside of a premium, right? We've taken out buy-side liquidity. Now, I don't want to repeat myself over and over, but it's important you get this. We've taken out buy-side liquidity. We've closed inside a premium of this candle's body. The body, remember? And now we get a huge delivery to the sell side. What are we aiming for? Well, you can aim for this candle's bottom half of the body. That's one target. But the overall target, the sell side liquidity that rests below here. Okay? Really simple stuff. If we break this down even further, let's dive into the 1 hour chart. Look at this, right? We got the weekly close. Weekly closed inside of this zone. This top half, exactly what we wanted. Now we go into the next week. We want some form of premium inside of a premium, okay? We run above highs, above the weekly open. Liquidity gets taken above here, okay? Liquidity gets taken above here, and then we shift. Look at that. Is that not a shift in market structure, the one I showed you earlier? Then you can take sells inside this fair value gap. That's the 2022 model. If that's not obvious to you or you're away from the charts, there's so many entries inside here. Order block. The 3 up close candles right before we rebalance and imbalance. There's an order block in there. As we run into it, that's a sell, okay? So we've outlined all the context and how we use each part of the candle to our advantage. Remember, it's all about candle anatomy here. I taught you how to use every single part of this candle to your advantage. It tells you a lot, okay? Candle anatomy tells you so much about what the next candle will do. So you may be asking, how do we know this candle is going to be another expansion? Okay. So once we've outlined all this, we move forward. We've taken out the sell side liquidity here. So what are we waiting for? Well, if we readjust and look for some context, you can see we have an order block. Okay. The last up close candle left before we get the change in the state of delivery. Once this candle's body closes below this one, we have a change in the state of delivery. Now the algorithm wants to seek sell side, okay? Now the algorithm starts delivering sell side liquidity. So how do we frame this, okay? We've closed below this candle's low. Here's some more source. Remember, we used this fractal. Now let's look at the low here. So how, you may be asking, Loz, how do we know it's going to continue down from here? We're still using candle anatomy. We're still using this candle. How do we know? If this candle's body closes below this low. As simple as that. There you go. That's it right there. If we wick down and then let's say this body closed up here, then it wouldn't be valid for more shorts because we didn't close below this candle's low. But that is what I'm looking for. That's all I'm looking for to confirm that we are going lower. We need to close below this candle's low. Notice how we've used every single part of this candle. This is candle anatomy. This is what I'm trying to teach you. And I hope this reaches a wide audience because it's so important. This is the key to ICT concepts. So which part of the candle do we use? Once we've traded below and we know next week is going to be bearish, which part of the candle do we use? You can use the body because that's where I said the bulk of the volume lies. If you're a bit impatient, you can also use the low because in theory, this should reject as well. Okay, so you can use the body and you can see here the bulk of the volume does lie here. That would have been a cleaner entry, but this works as well. So we knew before this week even opened, we knew this candle was going to be bearish. And by the way, quick note, this works on every time frame. This works on the 4 hour, on the 1 hour, on the 15 minute, on the daily, on the monthly, every single time frame. This is candle anatomy because this is what the algorithm refers to. The algorithm uses every single candle. You need to start using every single candle as well. So we close below the low, okay? The low of this fractal. Now we know this week will expand. So we have an open, a high, a low, close. Let's dive into this candle really quick and I'll show you how we can frame a trade in here. Okay, so let's grab our weekly open as usual. 5 p.m. Sunday, okay, or 6 p.m. Here we have the weekly open. Let me make that a different color so it stands out. This orange line is the weekly open, okay? This blue line is the candle's low. Remember that weekly low back here? This is that candle's low, okay? This is the body. Let me make that a bit bolder. That's the body, okay? Let me just write body here so we all understand what this is. Remember I told you we want to be selling above weekly open. Look what happens here. On Tuesday, which creates the high of the week, we take out buy side liquidity, all of this as well, these equal highs got run out into the candle's body. And then we break down, we get a shift in market structure because we broke this low that created this impulse swing. We have a high, a low, impulse swing higher, and then we break the impulse swing. So we have a shift in market structure right here. Once we have our shift in market structure or change in the state of delivery, in this case it was shift in market structure, we can now start looking for sells. Where does a sell appear? A fair value gap right here. Now you may be waiting for price to come back up into this actual gap, but if you've watched the 2022 mentorship, you know that we use the first fair value gap. It doesn't need to come all the way. We take a sell from here. Okay, so you would take a sell here, stop loss above this because it's a swing high. We have a candle to the left of it, a low to the left of it, sorry, a high even, a high to the left of it, and a high to the right of it. This is a fair value gap. We take sells from there and we run lower. If you miss this entry, look what happens, okay? Where do we reaccumulate, by the way? Look where this fair value gap lies. This fair value gap lies at the weekly candle's low. If you remember, this blue line is the weekly candle's low. Look where the hourly fair value gap forms. Right on the weekly candle's low. Okay, that is not a coincidence. Remember I told you, all of these levels of a candle all mean different things. Okay, we can use them on the hourly chart. We can use them on the 15-minute chart. This is what the algorithm is referring to. We have an opening price here. We break below opening price and we begin to consolidate at opening price. Once we do that and we've traded into a premium, remember there's a body here and that weekly low. The whole anatomy of a candle we're using. Because we've got that context of trading into a premium, once we begin to consolidate at weekly opening price, we can take sells from here because it shouldn't need to come any higher. There's no reason for the algorithm to come higher and start referring to buy side liquidity because we've swept up enough buy side, we've come into the body of the order block, and we've come into the low of that weekly candle. We're using candle anatomy theory to frame a trade here. We've also given a 2022 model entry. So we can take a sell here because we've begun to consolidate and we've got all of this context. Where would we put a stop loss? Ideally above this gap in case we want to come up and reaccumulate inside here. And you would take sells. I usually take a 1 to 2 and that would be enough, okay? But notice how we've used the whole weekly candle as our context. Now, again, how did we know this week was going to be bearish? The same exact thing. We used the previous candle. Where did this one close? Below here, right? After doing what? After reaccumulating at this order block. So we've reaccumulated positions at an order block and now we have closed below the previous candle's low. Okay, we've wicked into the candle's body and closed below the low. This candle should open up and do the exact same. And look where, again, the anatomy of a candle. Look where the high is put in. If I get rid of this candle's low is used as resistance. Okay, we've used this candle, and this candle, and this candle all for context. Okay, the high is put in the Judas swing because we're expecting lower prices. The Judas swing is put in this candle's low, and look where sell side liquidity is resting there. Okay, you've also got sell side liquidity here. Okay, if we dive into this lower time frame and we look at whole context here, Sunday's opening price is down here. Okay, we go lower, we take out a low inside here, which on the daily chart is also an external low. Then this candle closes back inside the low of this one. So this is really deep here. You've got to focus because we're switching between time frames now. It's where it can get complicated. But remember, weekly candle low, okay? Previous week low. There. Previous week low. We've taken out liquidity below the low, and the daily candle has closed where? The daily candle has closed above the previous week low. This is a weekly low, remember. Daily candle closed and rejected the previous week low. We can now expect our retracement because we're bearish. Okay, we're not selling below old lows. We sell in premium. Okay, we sell in premium levels. We reject that and then we rally. Where do we rally to, and where does it stop rallying? It stops rallying in on the prior week low. Okay, the week before this one, it stops there. That's used as resistance. It overlaps with a fair value gap, making it even more higher probability. I keep saying it, but we use the anatomy of these candles and you can see how useful it can be. Again, how would we know this candle is going to eventually reach for sell side here and this higher time frame target? Look at what the daily candle does here. After rejecting the weekly low here, where does it close? Guys, it closes inside the candle's body. Now, it doesn't close in a premium, so it's not as high probability, but it does close inside the body. Okay? This body is really elongated. Okay? It's a larger one. So it closes inside here. We then get a Judas swing, and then we rally and take out the sell side liquidity here and the sell side liquidity here. All from using candle lows and candle bodies. Okay? It really is as simple as that. Okay? Now, if we look here again, I want to show you another example where it doesn't work perfectly, but it still works. If I clear up all of this, and this is on a weekly time frame, remember guys, you can use this on the daily, the monthly, whatever. We take out a weekly low, we reject it into a fair value gap, by the way, and this candle's body closes inside the previous candle. Look what the next candle does, expands. If we head over to the daily, let's get some more context here. Okay? Look what happens as we dive into this. We've come below and then we reject. Okay, we get a change in the state of delivery on the daily chart. This becomes our order block. Down close candle, once traded above and closed above, becomes our order block. We wick into it, into a discount of the candle. If you take this candle's body, 50% is about there, that's below 50%, and this candle wicks and closes inside the last candle's body, as you can see there. The next candle does what? Open, low, high, close. And then because we've closed above this candle's high, really high above it, open, low. Look where it makes the low, okay? It makes the low close in the proximity of this, and if you take that there and extend that out in time, the top half of this candle, okay? The top half of the candle, we open up, wick down, and then move higher. I guarantee there is a nice fair value gap here. When we're expanding towards a target, bullish wise, we're using the top half of this candle and there's a fair value gap inside there. We're using that. That's a high probability fair value gap. It does it again here. Okay. Once again, here. Top half. Again. Top half. Okay. And that is how we use anatomy of a candle. Look at this. Use this, okay? Smooth edges, okay? So when we have where there's barely a wick, there's lots of liquidity lying under there because like I said, the volume lies in there. We wick above, take out buy side liquidity, and close strong, okay? The next candle opens up, closes inside the bottom half of this. So we're at least going to take the prior day high because we've taken out sell side liquidity, closed inside a discount of this candle. Now, this high should get ran in theory, and it does here. But what if we continued and closed here? I would expect this high to get ran, but it doesn't. Price rejects. Do we close inside the body? No. So I would skip this day. Again, we take out the low, close inside the wick. I'm not interested. Okay, and then we get a huge expansion to the downside, taking out sell side liquidity, and we do it once again. Open one because we've still got a target intact down here. We get an open, a high, a low, and a close. Okay, look what happens then. Look, we take out sell side, but we don't take out buy side. We close down here, and then we get a day where we take out the prior day high, but we don't close inside the body. So these days are skips. Then we get a day that closes after taking out buy side liquidity. Okay, remember it was into this fair value gap, if you recall, close inside the top half, and then we get a huge drop down again. Okay, this happens multiple times. As you can see here, it does it once again, closes, and then we get a drop down. And partnered with the context, you can see we've taken out sell side liquidity below this low. If you went through this price leg, you would see the exact same thing. Okay, let's shortly just go over it. Wick into a discount array, close inside the previous candle, not quite the body, so it's not ideal. Okay, where do we reaccumulate after expanding above highs? Look at this. A previous high, which on the weekly chart is probably a high. Previous week high, okay, on the daily. Once traded through, partner with a fair value gap, we reaccumulate, and the low of the week gets put in the previous week high, okay, and then we expand. You can see here just how much this works, okay. Go and back test all of these different levels of a candle, okay, multiple levels of the candle. We have the open. I'll go on the monthly chart. We have the open, we have the low, we have the close, and we have the high, okay. Each one and what each one does tells us so much about the next candle. Again, why did this candle expand and take out this low? Why did it do that? Because this candle took out buy side liquidity and closed in the top half of this candle's body. Okay, that is all we need. Then the next candle took out the first candle's low. So we've used this whole candle to tell us what the next two candles will do, especially this candle. This is where the easiest market maker sell models and buy models are formed. Okay, so this is candle anatomy. If you did enjoy the video, please do drop a like and drop a comment saying candle anatomy if you made it to the end. I want to see how many of you sit through my videos and make it to the end. So drop a comment saying candle anatomy if you enjoyed the video and made it this far. With that being said, I will end the video here. I don't want to give away too much because I can make a part 2 on this if you guys want it. Okay, a part 2, a part 3. I could talk about this stuff for hours because it is what the market runs on. This is what the algorithm refers to. Each one of these levels, these 4 levels here, tells us something different. Okay, so before I get started on a ramble again, I will end the video here and save it for another part. As I said, if you enjoyed the video and if you're new, subscribe and drop a like. Turn on post notifications and check out the links in my description below. As I said, my private mentorship is the first link in the description. Okay. With that being said, it brings us to the end of the video. I will top it off here. And thank you as always for watching. I will catch you in the next one.